Have you ever felt overwhelmed by the countless investment options available? You're not alone. At Fire Movement Lab, we're here to simplify things by breaking down the top 5 investment strategies for beginners. You'll learn how to build financial independence step by step. These strategies are all about simplicity, stability, and growth potential. Ideal for those new to investing, but eager to make their money work smarter. Whether it's index funds, ETFs, dividend stocks, or real estate, we're giving you a beginner-friendly blueprint for success. Ready to find out which investment strategies will set you on the path to financial independence? Let's jump right in. Let's kick things off by diving into index funds, the backbone of many successful portfolios. You've probably heard about them, but do you know what makes them so popular among beginners and seasoned investors alike? Index funds mimic the performance of a specific market index, like the S&P 500. With one investment, you're buying shares in hundreds of companies across different sectors. Imagine having exposure to tech giants, pharmaceutical companies, and retail leaders all at once. It's like putting your money on the entire economy, not just one company. Unlike actively managed mutual funds, index funds are passive by nature. They simply track the index, so you're not paying hefty fees to fund managers. Instead, the fees are incredibly low, sometimes as little as 0.03% per year. The less you pay in fees, the more of your returns you keep. Over time, index funds have consistently outperformed most actively managed funds. If you invested $10,000 in the S&P 500 back in 2000, that money would be worth over $50,000 today. Sure, the market fluctuates, and index funds aren't immune. When the market drops, your index fund investment will drop too, but you're still diversified across hundreds of companies, reducing the impact of any single stock's poor performance. The trick is to hold steady for the long term, because history shows that the market bounces back. You might be thinking, how do I start? It's simple. Most brokerage firms offer index funds with low minimum investments, and some even let you buy fractional shares if you're not ready to commit to a whole share. One last thing to consider: automate your investment contributions. Set up automatic deposits to your index fund account every month so you don't have to think about it. This strategy, called dollar cost averaging, means you're buying more shares when prices are low and fewer when prices are high, smoothing out market volatility. So, what do you think? Are index funds a solid fit for your portfolio? Stick around, because we've got even more ways to grow your wealth. Now let's explore exchange-traded funds, or ETFs. You might have heard them mentioned alongside index funds, and there's a good reason. They share a lot in common. But ETFs have some unique twists that make them stand out. So what is an ETF? It's a type of investment fund that holds a collection of assets like stocks, bonds, or commodities, giving you a diversified portfolio in a single investment. Like index funds, they often track a specific market index. Here's where it gets interesting. ETFs trade on stock exchanges, so you can buy and sell them throughout the day like any other stock. Imagine this: you're watching the market and notice a dip in the tech sector ETF you're interested in. You can capitalize on that opportunity by buying shares right then and there. That's the flexibility of ETFs. Liquidity at your fingertips. Like index funds, ETFs are passively managed, so their expense ratios are much lower than those of actively managed mutual funds. With brokers offering commission-free trades on many ETFs, you're not just saving on fees, but gaining immediate market access. ETFs come in a vast variety. Interested in renewable energy? There's an ETF for that. Curious about international markets or corporate bonds? ETFs provide diversified exposure across different sectors. Now, you might be wondering about the risks. While ETFs provide excellent diversification, they can still be affected by market volatility. It's crucial to choose ETFs that align with your goals and risk tolerance. Some ETFs might focus too heavily on specific sectors, which could expose you to greater risk. Consider a mix of broad market and sector-specific ETFs to balance out your portfolio. For instance, you could invest in a total stock market ETF while adding a healthcare sector ETF for targeted exposure. ETFs offer flexibility, diversification, and cost efficiency, making them a versatile addition to any portfolio. Stay tuned, because we've got more insights coming up. Dividend stocks can be a fantastic addition to your investment strategy. Imagine this: every quarter you receive a check simply because you own shares in a company. It's like earning money while you sleep. What makes dividend stocks stand out? Here's the idea. Dividend stocks are shares of companies that regularly pay out a portion of their profits to shareholders. Think of them as companies rewarding your loyalty with a steady stream of income, even when the market gets rocky. Let's break down why this matters for your portfolio. First, reliable income. Established companies with consistent revenue streams can continue paying dividends even if stock prices fluctuate. It's like a safety net, giving you peace of mind regardless of market volatility. But there's more. Compounding returns. If you reinvest dividends, you're using that income to buy more shares, generating even more dividends. According to Hartford Funds, dividends have historically contributed nearly 40% of the S&P 500's total returns over the past 90 years. That's growth you can't ignore. And let's not forget potential for growth. Companies that regularly increase dividends, like dividend aristocrats, can offer steady income and capital appreciation. Johnson & Johnson, for example, has raised dividends for over 50 consecutive years. Not all dividend stocks are created equal. Some companies offer high yields but have inconsistent earnings or operate in declining industries. The trick is finding those with a history of increasing payouts while maintaining strong financials. When considering dividend stocks, think about how long a company has paid dividends, if payouts are growing or stagnating, and if they're overextending themselves. Choose wisely, and dividend stocks can provide a steady income stream that grows over time, supplementing your paycheck or supporting you through retirement. Stay tuned as we dive deeper into effective investment strategies. After dividend stocks, let's dive into Robo-Advisors, the new kids on the investment block gaining popularity among beginners. What makes them so appealing? Robo-Advisors are automated digital platforms that use algorithms to create and manage your investment portfolio. They act like personal financial planners, but with a difference. They cost significantly less. Annual management fees range from 0.25% to 0.5% of your assets, far lower than traditional financial advisors. Automated portfolio management is a key feature. Robo-Advisors consider your goals, risk tolerance, and time horizon to build a personalized portfolio. They automatically rebalance your investments to keep you on track. Tax loss harvesting is another valuable tool. This strategy offsets gains by selling losing investments, minimizing your tax liability. Wealthfront claims tax loss harvesting can increase returns by over 1% annually, making it a smart way to optimize your gains. Worried about accessibility? Robo-Advisors have made investing simple. With low minimums and intuitive onboarding, platforms like Betterment and Wealthfront help you set up an investment plan in minutes. No guesswork, no hassle. Now, what about the risks? While Robo-Advisors excel in low-cost automation, some investors may prefer personalized advice when facing unique financial challenges. Algorithms can't always account for complex life changes, which may require a human advisor. However, Robo-Advisors often offer access to licensed financial advisors for an additional fee. You can get the best of both worlds. In a nutshell, Robo-Advisors make it easy for anyone to start investing with diversified portfolios tailored to their goals. How could automated investing transform your financial future? Stick around as we unveil one last powerful strategy. Real estate has always been a solid investment choice, but it can be intimidating for beginners. So how can you start investing in real estate even if you don't have tons of money up front? First, consider steady cash flow. Owning a rental property means consistent monthly income from tenants. According to Roofstock, a well-managed rental property can yield an annual return of 6 to 8%, outperforming many traditional investments like bonds or savings accounts. Beyond rental income, there's also appreciation potential. Property values typically increase over time, and the Federal Housing Finance Agency reports that U.S. home prices have risen by 4 to 5% annually since the 1990s. You benefit from both rental income and the eventual increase in property value. Real estate is also an excellent diversification tool. Property prices don't necessarily correlate with stock market fluctuations, reducing your overall investment risk. By adding real estate to your portfolio, you stabilize returns and gain exposure to a different asset class. But what if you're not ready to manage properties yourself? Consider real estate investment trusts, EITs. These companies own and manage income-generating properties like apartments, offices, and shopping centers. Investing in REITs gives you access to real estate's income potential without direct property management. and they often provide attractive dividend yields. As with any investment, real estate comes with risks. Rental properties require time, maintenance, and the ability to handle tenants or vacancies. Make sure you're financially prepared for these challenges. Whether you're looking at direct ownership or REITs, real estate can help stabilize your portfolio and bring reliable returns. And there you have it, the top 5 investment strategies for beginners. By understanding these strategies and implementing key lifestyle adjustments, you're already on the path to achieving financial independence. If you found value in today's discussion, don't forget to hit that subscribe button, give us a thumbs up, and stay connected for more empowering content. This is FIRE Movement Lab, where your financial freedom comes to life. Keep planning, keep striving, and we'll see you in the next video.